Could 2026 be the year small-cap stocks outshine the S&P 500? As the Magnificent Seven tech giants stall, a new opportunity might be emerging under the radar. Discover why small caps could be the hidden gems of the stock market. In recent years, the stock market has been dominated by the big tech names, overshadowing smaller companies. However, with the current market dynamics shifting, it's time to look beyond the Magnificent Seven. This video delves into the potential of small-cap stocks, especially as interest rates are poised to decline. As the S&P 500's tech-heavy focus evolves, understanding the value and potential of small caps could be crucial for investors seeking growth in 2026. We'll explore why small-cap stocks might be positioned for a comeback, examining factors like interest rate cuts, potential changes in Federal Reserve leadership, and undervaluation. Additionally, we'll discuss the broader market outlook and why a diversified portfolio, including small caps, might be beneficial. Stay tuned as we unveil expert insights and predictions on why small caps could surprise investors in the coming years. The investment world has been buzzing with discussions surrounding the Magnificent Seven, the tech giants that have led the charge in recent years and seemed to overshadow other market segments. However, as these mega-cap tech titans begin to lose steam, there's a growing interest in the parts of the market that have been flying under the radar. One such segment includes small-cap stocks, which have the potential to deliver solid returns, especially if the market conditions are right. With interest rates potentially decreasing and the broader market starting to diversify, investors are considering whether small-cap stocks might outperform the SPY in 2026. Small-cap stocks, typically defined as companies with a market capitalization of between $300 million to $2 billion, have certain advantages that can make them attractive to investors under the right conditions. Particularly, they are perceived to benefit from interest rate cuts, which can ease the debt burden and open doors for potential mergers and acquisitions. As the Federal Reserve looks at appointing a potentially more dovish leader, the prospect of more favorable interest rates becomes a possibility, offering a brighter outlook for smaller companies. This environment creates a conducive setting for small caps to thrive and possibly challenge the performance of larger indices such as the S&P 500. Despite the potential for outperformance, there's skepticism about whether small-cap stocks can consistently outpace the S&P 500, especially since large-cap companies have dominated for so long. Historically, economies of scale and the allure of big tech's role in AI advancements have justified higher valuations for these larger firms. While some analysts argue that the high valuation of the S&P 500 may weigh on future returns, it's also important to consider the appeal that large firms continue to hold, particularly in technology. Even with the macroeconomic environment becoming more favorable for small caps, questions remain whether they can overcome their historical trends and deliver sustained superior returns. Opinions vary among big banks and market pundits on the potential of small-cap stocks relative to the S&P 500's outlook. Given the impressive returns of the past decade associated with the S&P 500, there's growing sentiment that small caps could close the performance gap by 2026. This scenario seems plausible, especially if investor focus shifts from growth stocks to undervalued, lower multiple stocks, such as many of those in the small cap category. As the race heats up, possibly influenced by macroeconomic improvements, the opportunity to discover hidden gems in this segment is increasingly appealing for value-focused investors. As we approach 2026, the contest between the S&P 500 and funds focused on small and mid-caps, like the Vanguard Mid-Cap Index Fund ETF, appears set to be a close one. Instead of viewing this as a binary choice between small and large caps, there's merit in diversifying across both, each offering unique opportunities in a changing macroeconomic and technological landscape. The mid-caps, balancing between the stability of large firms and the growth potential of small caps, present an intriguing proposition. With the AI revolution promising continued disruption and opportunities across the board, having a well-rounded portfolio that includes both blue-chip and emerging smaller names could be a wise approach for the coming year. To summarize, small-cap stocks have been overlooked as tech giants dominated the market. However, with the potential for interest rate cuts and a broader market shift, these underdogs might just surprise us in 2026. While the S&P 500 remains a staple, the value hidden in small and mid-cap stocks cannot be ignored. With an improving macroeconomic picture, it's time to consider the benefits of diversifying into these lesser-known stocks. Are you ready to broaden your investment horizons? With small caps potentially poised for growth, how do you plan to diversify your portfolio for 2026? Share your thoughts in the comments below, and don't forget to subscribe for more insights into the ever-evolving stock market landscape.